want to be here in St. George, you've got 360 homes to choose from.
Yeah, and I just recorded because we don't have a ton of people jumping in yet, and I definitely want to post this in the WCBR Facebook group. Yeah, Kara Street says that's insane. I got Carl Wright on here. What we're doing is we're talking about current supply and demand in the market right now. So as of right now, Greater St. George single family homes, you can see we have 360 homes available in supply. And if we click on the demand, as of right now, we have 468 under contract. Yeah. So there's more homes under contract than we have in total volume available in every price point single family homes.
I don't remember ever seeing that where you have more pending than active listings.
Well, and it's tough because looking at this, you could see they're almost identical, right? Yeah. Right here is the pending. So we're up 27, 28%. And we're down 25% in active listings. So we're up in pending and down in active. This crisscross, this didn't ever happen. I mean, you're going all the way back to 2006. You know, the demand pended listings, there was a little bit of getting closer together back in 2004 and 5, but I don't think it ever crossed. Carl, do you?
No, I never saw it. I mean, we came close in 2018 right there. We came close, but it still was not, we still have never seen more pending or contingent and versus active.
Yeah, look at that. Active listings in June of 2018. That was the other bottom, and that was value was 869 homes. So we have crept down below 1,000 here in the last few years, but we're at just another extreme, which is funny because I wouldn't have said 2018 was really felt like it was that crazy of a market. I think because we had such a contrast between the beginning of the year and what's going on right now, that's what probably makes it feel like we're in an even crazier market than we were in 18. What was that? Anybody say something? Yeah, so this was one of the things.
Hey, Robert, I want to know. Robert, I want to know what you think is. What's the healthy? Where do you see it being healthy then? All right, so we're crazy. What should we be targeting?
Well, I think a healthy target growth in supply and demand is probably around that ratio is probably, and I'm trying to think of like what I would say is healthy. I would say that this is probably the healthiest time that we had, is where we were at about 1,500 listings and our under contracts at any given time was like 6 to 7. Because this is, if we're looking at the appreciation of value, this is probably more along the lines of a 5 to 6%, 6 to 7%, where this is what I wanted to talk to Carl about was because of this supply driving lower than demand, our price point, if I look at this chart right here, right, we look at typical supply and demand curves, this is where the price is where these two things intersect. And so a healthy growth, I think, across the board has been between 5 and 7%. 7% is insanely fast. But when we start getting faster than 7% growth, we start to create an imaginary bubble, because this isn't necessarily a product of we have the actual buildings that we can sell. This is a product of we actually don't have the number of homes we need for the people that are here that want to buy them. And when that happens, that's when you're getting into that imaginary zone of where value isn't matching because there actually is no supply. We want to make sure that our supply and our demand, like the number of home starts, is equaling the demand for new people wanting to get into the market. I think that's a healthy number. I don't know exactly what the number is. Carl, you might be able to touch on it, but that's where I think health is.
Yeah, I think you're right. I think when you look at absorption rate, you want to be about a 3 to 6 month inventory for homes. That gives your buyers the option to look around and see what's around. Right now, as soon as a house goes on the market, my neighbor three or four doors down, he put his house on the market 2 days ago and he's got multiple offers because it's almost like a piranha frenzy. You know, you throw that piece of meat into a piranha and everybody's just trying to go. And if we don't buy this right now, then we're going to lose out on an opportunity to be there. And we better go in with a high offer. And you know, it's a frenzy. So people aren't really getting what they exactly want. they're getting what is available, and that's that can create a problem. So
yeah, so I think 3 months of inventory, right? So July of 2019 was 3 months of inventory. Year to date in 2019, we had 3 months of inventory. We're down to 2.8, and just month over month, July 2020 versus July 2019, we're down below 2 months of inventory, right? We can see the median days on market is 28 days on market. And this is just residential. So this doesn't have any commercial or land calculated in here. But those numbers are extreme. We're down 15%. Homes are going 15% faster now than they were a year ago. Absorption rates down 12%. But values, this is the craziest. This is crazy to me. Is that the average home sale a year ago versus this month is almost 50,000, $60,000 more. Our average year to date price has gone up by $35,000 in a single year. That's what's a little concerning, right? When we talk about like pace, this is okay to go through these rolls as long as we can get our supply back up if demand kind of stays down. But I don't think demand's coming down. I think if something's going to give first, demand has to give first, because we're not going to magically build 1,000 homes, right?
Right.
So,
and
go ahead.
I think we're just at the tip of the iceberg right now. We're going to see more and more people come to St. George. Number one, because we've got great weather, we've got great amenities and things like that. But a lot of people, we're seeing a mass exodus, and we've always had this conversation, right? Everybody from California is coming here, but I think the political climate right now is forcing a lot of people to say, you know what, we're out of here, and they're come to Utah. So
this is actually really interesting, and I'd love to hear anybody else's thoughts on this. But just right along those lines is what we're looking at. This is unemployment and things like this, but even more so, just exactly like what you said. So this is as of 2018, where we got our population for in Washington County. Majority of them came from Salt Lake, LA County, Utah County, Davis County, and then Orange County. Mm-hmm. And then we're basically losing nobody to nowhere, if we were to talk about like who we're losing people to. But yeah, I think this is the trend. Even though this is from 2018, I would be surprised if this is much different.
Makes sense.
What do you think, Carl, as far as appraisals go, how do you think this is going to affect the pace moving forward? Do you feel like the appraisals are going to at least keep values from really starting to explode, or what are you seeing as far as what banks are allowing you to do as far as appraisals and things like that?
Right, that's a great question, and I'm glad you addressed that, because we are seeing right now appraisals are historic in nature, right? Meaning that we take historical data, closed sales that closed in the past, to try to represent the current market values. So we have a difficulty so we haven't caught up yet to what the demand is. We're using comparables that may be slightly dated. And so we're trying to use the most current comparables. If I've got a house that sold in June or July, I'm going to use that, or August, versus a house that sold in March, because that's when, you know what I mean? So we're going to try to use the most current sales. But with this multiple offer asking or contracts above list price, don't be surprised if the appraisal doesn't hit value. We're seeing that more and more right now. So just prep your sellers, prep your buyers. If you're coming in over list price, we're doing our best to try to push that to get the numbers as high as we can, but we're coming in short many times right now. It's just the way that the market corrects. I would suspect in the spring that those numbers will catch up, and we'll see that growth. We'll actually have the comparables from August, September, October that happens to help our values in the spring when the parade of home hits. So it just takes a minute as values and supply goes down and demand goes up. The values will come up eventually. We'll see more cash buyers. I saw a house yesterday that closed on the MLS, a walkout basement, 22 over 22, that sold for like $680,000 in Serenity Hills, which was like, it was like $200 a foot for a walkout basement, which I've never seen that. It was crazy. And so we're seeing, and it was a cash buyer, 2 days on market, and they just came in and paid cash. So the more cash buyers we have, that'll help increase our values and help increase appraised values. So just be patient in this transitional period. I mean, we went from like, we had this conversation, what was it, 4 months ago, when we were like, crap, we've got a lot of inventory right now. We're talking about, nightly rentals that are just, we've got a huge inventory. We got 9 months of inventory of nightly rentals. And now we have no inventory.
Yeah.
Like, gone from one extreme to the other. And so it's kind of,
It's a roller coaster.
It's a roller coaster. So just, if everybody just needs to be patient with what's going on and realize that values may take a minute to catch up. So don't be surprised if your appraisals are coming in short. You may have to go back to the negotiation table. And I get it. There's multiple offers, there's things but we have to fit our appraisal into this cute little box that Fannie Mae and the banks give us. And if we don't meet those guidelines, then they won't accept it anyways. So we're not here as appraisers to try and kill deals. We're trying to help everybody make this deal work. So just be patient with us and don't take us to the firing squad if we come in short.
Well, there's a couple. I'm not going to speak for all the appraisers that are trying to do that, but I know you guys are doing the very best that you can. The challenge that I'm seeing from what you're saying is we might not see a big bump in values up until spring, because it just takes that long for the number of comparables to match up, so that you have 3 or 4 that can match to help drive that, right? So when we're trying to sandwich the value, you have something a little higher, something a little lower, something in the middle, and kind of the process that you guys go through. So springtime is when you're saying, from a comps perspective, you'll be able to help support. But if we continue to kind of outpace that, we might be still trying to play catch up. The thought I have, though, and I'd like to hear anybody else's thoughts on this, is around cash buyers, is that it's essentially free to get a mortgage right now. If we were to actually just talk about 2 things, the value of an inflated dollar being around 2% year over year, right? The dollar is going to be worth 2% more next year than it is the next year after that. Historically, we don't know what that's going to do moving forward, but if a mortgage, if you could get a mortgage for 3% or under 3%, if you're paying interest on a dollar at 2% or 3%, but the inflated value is 2%, there's really not a huge cost. It's essentially almost a free dollar that you're getting from the bank. Why would anybody be paying cash for a home? That's not, that wasn't rhetorical, please. Yeah, Renita.
People don't like to pay interest, Robert.
Yeah. Well, the fundamental reason that they would pay cash, if even if money's free, is because they don't have the appraisal. But what I wanted to say, I think that what we get paid the big bucks for is helping our clients navigate, the market regardless of the condition. And I have the conversation with my sellers, about the appraisals. And I say, look, it's kind of like the market is this kite, and it's going higher and higher and higher. The appraisals are holding the string of the kite. And if the appraisers weren't there to hold the string of the kite, I mean, it would just be utter chaos. So, understanding that we may get, just preparing them, that a home may not appraise, and then have the conversation with the lender and the buyer's agent. What are you prepared to do, if we don't appraise? And be grateful, really, that we've got something here in the market holding the string on this kite.
I think that's a great point. Absolutely.
For sure. And it's not like, I mean, I don't want to, we're doing the best that we can. We have to keep those values. I would say when you're prepping your sellers, just base your data on facts. Base your list price on facts. Look at the comparables and look at what's selling in your market, in your neighborhood, and go through a true CMA. Don't just throw numbers out there, because if you throw a number out there, chances are you're going to get it. Yes, I understand, you may get it, but look at the comparables. It'll save time. It'll save headache if we price the homes right, especially in today's market. Look at what's active. Look at what's pending in your neighborhood, in your subdivision. Go through a proper CMA. Don't just throw out a number, because then it falls back on us. We look at those numbers, and then if we can't make the deal work, we can't make the deal work. So if we work mutually and help each other be able to price those homes, the process will go smoother. We'll be able to get through it a lot quicker. So
Yeah, I had a conversation with a seller just the other day where the numbers, like the appraisal, actually looks like this number could match, but I didn't think the market value was going to match, right? Where the market value is going to be, you know, up here and the appraised value is going to be down here. It's like the market will probably give you this, but you and I both know that the what's going on as far as what an appraiser is looking at and what the numbers have been showing is that this is where you're going to have to land as far as value goes. We see all these people pricing their homes up here, but what's closing is far different. We're seeing that active, what's listed for price be a lot higher than what's been closed historically. So kind of keeping anchored onto that. But Kate, I want to ask you about people don't like paying interest. And then Renita actually answered the question for me about saying, well, if they can't get the appraisal, then they'll pay cash for it. But you said that people don't like paying interest.
First of all, you guys aren't going to like to hear this, but just going back to the appraisal thing, I've seen now a couple times where homes have appraised for far more than I thought that they could. And I'm not saying to bank on that, but if I'm a seller, I'm probably going to shoot for the stars. And if the appraisal comes in lower, what have I lost? I mean, I might as well try for the higher number and see what happens. And going along with what Renita said, if the appraisal doesn't come in high enough and I'm getting a loan, I can still just choose to pay cash for the difference of the appraisal and the purchase price instead of the full thing in cash. Right. That would lead into what you were asking about. Why would someone pay cash? Well, there are people out there that they don't want to pay an origination fee. They don't want to pay the costs associated with getting a mortgage. They don't want to have a monthly payment. They don't want to pay interest. So that would be a reason to pay cash if you have it. Now, I understand in your financial mind right now, you're thinking, oh, okay, well, instead of buying one property for $200,000 with cash, you can buy 5 properties and just, you know, put $25,000 or $20,000 down on each of them. And yes, that is correct. That's just not what everyone wants to do. Everyone doesn't want to leverage themselves that far.
Yeah, and I think probably my example would probably be, if somebody wants to do that, that's great. But keeping liquidity, knowing that we're going through this market that's going up and it feels like we might never end, right? It feels like, hey, everything's going to be great, but we all know that the pendulum has to swing back the other way, right? I would be surprised if anybody here thought that eventually somewhere down the line that those prices aren't going to stabilize and come back down, right? So if we're paying top market that we've ever seen in the history of Washington County, the thought that that's just going to continue on forever is probably not reality. So keeping some kind of liquidity and not over leveraging, at least from a cash position, is I probably want to have more cash on hand. I'd rather leverage the bank's money than my own money and keep that on hand for a rainy day, so to speak. Mm-hmm. So that would be my perspective, not go buy more properties, but potentially not spend the money that you don't necessarily need to spend because the cost of it isn't all that great. Where if I was to pay cash for something outright and all of a sudden the value is cut in half or drops by 20%, maybe that's not the best thing. But again, I think what Renita was saying is, you know, holding on to the string and advising with the market that we have now and not trying to anticipate in the future is probably good. One of the things
it's correct. It's just a matter of perspective. Like the amount of money that people have is different for everyone. And there's some people there that have a lot of money. And some of them are moving here. And so it's just a matter of perspective of where you're coming from.
Yeah, I totally agree.
I got to agree with Kate on that too, as far as the appraisal. I've had a couple of deals recently. I don't know, I think maybe 3 or 4 years I haven't had on the listing side or the buy side actually had an issue with an appraisal. And then I think my last 2 out of the last 3 deals I've done on the list side, we've had appraisal issues, which is fine, but I'm really glad that I didn't listen to myself as far as sold comps, because right now they don't seem to matter as much. The market seems to be pushing much harder, you know, versus what sold comps were. So we're talking about a difference on a couple listings of $30,000 to $40,000.
or $50 per square foot over sold comps.
Yeah, and I think that might be and not to say that I know that you sell quite a bit of homes, Dave, but could that be anecdotal where a couple of those examples could be unique? Because I would go back to Carl and saying, are we seeing that those appraisals are coming in lower than what the market values are? Is those sold comps actually holding true to what the values actually are selling? What's your leeway? Like how much over could you appraise a home for in the current market versus what the sold comps are?
It just depends on the market, the area. There's a lot of different factors that go in.
Could you sell it for 10% more than what the sold comps are?
We're pushing for that. I'm looking at like how much we've increased. If one of your slides show that we in the greater St. George area, we're having a 13% increase. So I can then say, okay, 1% per month approximately is what we're increasing. So if I've got a comparable that sold 3 months ago, I'm going to add 3% to that. It went under contract 3 months ago, I'm going to add 3% onto whatever that is for the market condition. So, we're investments for the market. And I agree with Cade, shoot for the stars, but just don't be mad at us if we can't get your value, like we want you guys to make as much money as possible. We want people to sell their house for as much as possible, but we also have to fit it within that box. But, we just do the best that we can. And, a lot of times I'll call our office is going to call you as a listing agent, be like, hey, how did you price this? Show me the comparables that you used. If you can't produce them, then we'll just do the best we can and go from there. So we just have to back it with some type of factual data to be able to say, like, here's where we're at. And so if we can't make it work, we can't make it work.
So this is what you're saying, like 11% year to date in changed values of average sales price. So you're basically saying, okay, if the sales price in this area has gone up this much month over month, you can use that to help grow the value. Got it. Correct. That makes more sense.
So, and we do it specifically to neighborhoods because some neighborhoods have, and market. So, the $200,000 to $300,000 range has actually gone up more than 11%, more like 15%. Yeah. So, if I'm appraising something in that price range, I'm going to use a different number than say an $800,000 to $1 million house. That hasn't quite increased as much as the $200,000 to $300,000 range. So we do it specific to the neighborhood and specific to the home.
Got it. That was really helpful. That's helpful for me. Anybody have any questions for Carl?
I don't have a question, but Carl, you appraisers have a really tough job right now. So sorry.
Yeah. Thanks, Cade. It is anytime these transitional markets happen, I'm like, oh man, we really have to work for our money on these ones. And these transitional markets are tough. So thanks for your patience as we go through these. And, we're doing the best that we can. We're using the data that we can, and we're trying to make deals work. And if we can make it work, we're going to make it work. But if we're not, there's probably a reason, and it'll warrant a phone call to the listing agent typically to say, like, hey, what's going on here? How'd you list this? Help me out here. What comparables did you use? And if you can't produce those, then we'll just do the best that we can and know that that's what we'll get out of it. So thanks, Cade.
Yeah,
I jumped on. Oh, sorry, I jumped on a little bit late. I do have a question, and sorry if this has already been addressed. Carl, do you have any numbers as far as the amount of appraisals that you're doing that aren't coming in at value, like percentage-wise?
I don't really track if I don't hit value, but I mean, I talked to Ryan Judd the other day. I talked to Nick, my partner. I talked to several people in the office, and even our appraisers up north in Salt Lake, and I'm like, hey, how's it going? Like, oh, just killing deals left and right, like that's the standard answer right now. And I'm like, gosh, I hope that not everybody's trying to kill deals, but we're in this transitional market, and that's what happens. So I don't have a specific number for you, Dave, of how many deals we're killing. I shouldn't say that. How many deals we're not able to reach the appraisal or reach the contract price. But, I would say 1 in every 5 or 6, maybe 7. It's not a high number, but there are those. I did one the other day where I was $150,000 off the contract price. And I was like, holy crap, I don't even know how you price this. I couldn't get it was I just couldn't. I don't even know where they came up with that price. It was in a residential neighborhood at $240 a foot, and I just couldn't. I had a house in the same subdivision that had sold, and
whoever that agent is making their money right there. Whoever that agent is definitely being able to show up to the listing agent or the seller and say, hey, look what I did for you. Look at all the value that I brought to the table.
Right. So
you just got lucky. That's pretty crazy. Hearing those types of stories are pretty crazy, but I know that there's probably not as much of that. I mean, 1 in 5 and 6, if that's the feeling, isn't. I thought you would have probably said more of appraisals coming in low. So we're not, even though inventory is so low, it's not completely out of control yet. At least the buyers are being reasonable. And then I think it also says something about the agents is not saying, hey, just pay whatever you want over asking. I think there's probably some advice going out there to say, hey, let's put reasonable offers out there to make sure that we don't run into an appraisal problem.
yeah.
So that probably is something to help for it.
Yeah.
Anybody else have some questions for Carl?
Carl.
Hi, Colette.
I think Renita says big
Accident.
thanks to the appraisers because I think we all know, we all share what Kate's saying is you guys got a tough job out there, and we don't envy you.
Yeah, right.
Affordable housing disappears. Hourly wage earners cannot afford to live here, which impacts the service sector of our economy. Not enough worker bees to support the hive. Yeah, and I think that's something to be said. I have some concerns around affordable housing as well. And it goes back to if we can't continue to build supply. I think I ran the numbers. New build accounts for around 20 to 30% of our entire inventory. So if you look at every single home, the amount of homes that sell over the course of a year in Washington County, I think new building is about 20% of that. Does that sound about right, Carl?
Yeah, that's about right.
So when we take the inability to have growth happen in that building, and it just, we can't grow at the speed that the demand necessitates it, that is demanding it, then there's just only so much that we can go. Those prices are going to continue to rise. I'd like to have some more from the city come on and talk about what they might be doing to help with some of the affordability housing. But also, I think there's a big opportunity for investors and builders out there if they can swing it. But construction prices, Kate, I heard lumber's gone up. Lori, I see Lori Burgess is on. If you want to touch on where construction costs are going. I've heard that they're going up, but I don't know if that's always true.
Hey, Robert, this is Mitch. I can just say real quick, they're absolutely going up. And that's looking at it from a, not only Desert Color, but a SunPro, different, sister companies of ours. It's a big struggle right now across the board.
Yeah, is it any one particular item? Because I know appliances.
Lumber is one that just really spiked really quick. And I've heard some appliances are on shortage, but they're trying to get, production back up.
Yeah, I heard lumber up as high as 20% up in value.
On my side, I've seen the lumber and concrete have my most recent increases that were notable. And then not necessarily a price increase, but just simply not having the ability to get certain supplies. So having a hard time getting specific appliances, fridges in particular are really hard for me right now. All sorts of random stuff like certain plumbing fixtures and like mirrors or certain light fixtures. There's just my suppliers, like the things that I've been ordering for months and months and months, all of a sudden those things are no longer available. So I'm trying to scramble to find similar replacements just because wherever they were made at, their plant probably got shut down. And so now they're backlogged.
Yeah, that's crazy. Hopefully that could catch up. I wonder how long that would have to go. So Lori's talking about they don't build vertical, they do mainly excavating, but they're seeing prices increase in several of their materials that they're using. So yeah, I think, I don't know how long that can last. It seems like from what I heard and what Mitch was saying, from at least the appliances, those supplies coming back up, but it seems like building materials don't always like go down as fast as they went up. And so if it costs more to build a home and the land to buy it costs more, it's hard to get in those lower price points. I'll bring up this slide as well about affordability index. So can you guys see this? I don't know if I clicked there.
We can't see yet, but while you're pulling up, let me add to affordability. A lot of you know that I've been building townhomes, and we're trying to make an affordable product, but lately people don't want townhomes built next to them. So getting the zoning is really, really hard. So it's an interesting dynamic where we want to build something affordable, but no one wants to live next to the affordable.
That's a tough one. That's definitely a tough one. So if we go back to affordability index, so if you guys are familiar with how it works, it's the three elements that go into whether something's affordable is the median income of the area, the median price of the home, and then the interest rate that are dictating how they lend on it. And so a perfect affordability score is 100. So 100 is exactly where a home is as affordable as it possibly can be. And then anything over 100 is more and more difficult as far as affordability goes. Anything under 100 is going to be pretty cheap to buy a home compared to the income, the price, and the interest rate that's there. So right now in June, we're at 101 and 12-month average in Utah. So this is across Utah, not just Washington County, but across Utah, it's at 102. So we're a little bit expensive compared to a perfect affordable index, but this is partly why our demand continues to stay strong, is that from a big bulk of the affordability, we're still in a good position. Prior year, we were at 97 is our score. And so as a 12-month average, the 12 months before the last 12, it was right at 100. So we are getting more expensive out of the affordability range, but it's not too far out of the zone. Thought that was interesting. And then this was another really interesting statistics that we found. I said this in my team meeting, and I encourage anybody here to do this as well, is to go find their own numbers and their own statistics. This is based off of Workforce Services, their numbers. So in June, unemployment in Utah was 5.1% versus across the country it was 11%. Job growth rates were still down 2.8%, but against the country at 8%. These are huge reasons why I think there's demand growing in Utah in general. Job sector growth, private sector job growth in Utah, only 2.7%. Yeah, so these I thought were pretty cool numbers, pretty interesting to see us versus the rest of the country. Does anybody have any thoughts on this? Not as interesting as I thought, probably. This was kind of like where we were at economically as a snapshot with unemployment. You see our spike early in the year, and then we've rebounded pretty quick in Utah. We were always pretty low, and we've rebounded quicker than the rest of the country. Washington County at 6% unemployment. This is really the only data I could find in Washington County. So if you guys have better Washington County unemployment rates, this is where I could find the best ones here. We're at 6%.
I think that's pretty correct, Robert. The last time I looked, it was 6%.
Okay, awesome. Yeah, I think that's helped. I mean, it's not, obviously I'd love to see everybody have a job, but this compared to the rest of the country, that's a positive sign for us, and continuing to allow, the people wanting to buy and also have a job here. It's still pretty good that they at least have a job, and we don't have to worry probably as much as affordability goes in other parts of the country, because at least from an unemployed standpoint, at least we have some money coming in. So I think that's good. Does anybody else have any other topics they want to discuss or have questions about they wanted to kind of present to the group? Wes, I see that you're on. If you want to talk about commercial, if you got a second.
How's it going?
Good, man. Good to see you.
Yeah, good to see you too. Glad to be on. As far as commercial goes, we're still still plugging along pretty steady. Our big challenge has still been inventory, lack of inventory. We got lots of buyers. There's still plenty of people with cash, 1031. People still looking to invest here. We've had a number of inquiries of people blindly looking to invest or move or relocate their businesses into the area, coming from New York all the way to California. So I think everybody's heard quite recently of the challenges the high schools are having with a lot of people trying to send their kids here to play sports or go to school, and that's just not based off athletics. There's a lot of people that are also noticing that we've been open and it's not as constrained as it is in other parts of the world, and so they're looking to relocate their businesses and families here as well, especially people that can work remotely. The challenge they're having is most of them can't find a home to buy when they do get here.
Yeah, or even a place to rent. I know Candace Cather's on. She's our property manager here at our office. How's the rental market from your perspective, Candace?
Everything, as soon as it goes on, it goes off, and I have people begging for housing rentals.
Homing is actually a pretty interesting way of looking at it. They need to homing. They are in searches of homes. Yeah, and I think that's true across the board. And not, at that point, we can't really affect that. I'm curious though, with the construction inventory of finding somebody that wants to build a building, or is it finding a location to where somebody would want to build it? So is inventory more stifled from interest in building commercial property, or?
I think you've got a little bit of both. There's probably one or two people here on this call that I've been talking to lately that want to find a location for their office and either want to buy an office building or build an office building, and to find a good location at a reasonable price has been a bit challenging. Things that have come on over the last 6 months have gone under contract fairly quickly, and given key locations, there's just not a ton of inventory that are where these people are like to locate their business, where there's visibility and good access. So from an investment standpoint, lease rates are starting to tick up, but as was referenced earlier here, you've got some of the cost of materials that are also increasing, so that hasn't quite caught up to make it affordable or interesting enough for investors to start speccing out space, whether it's retail or office. We have had a little bit of industrial spec space go up.
I really don't want to go through the weekend like this.
That's Lori.
We bought
Lori. I got it.
But yeah, so on the industrial side, we have seen some investment space go up, and that stuff's been absorbed fairly quickly, and they're even starting to move out as far into the hurricane area with some space to try to absorb. So it's been positive. It's just a matter of making the numbers work and finding land that's entitled and available to put some commercial construction in.
That entitlement phase, are you seeing that, like Cade was talking about with affordability, not getting zoning there on the entitlement side? Are you getting pushback from getting certain zoning set up to make the numbers work?
In some cases, yes. Some of it's based off of CC&Rs and other restrictions in certain areas. And then in other parts, it's an extended timeline where you could maybe 30, 60, 90 days get something entitled and in place now. It's taking 2 or 3 times as long, just given circumstances. And so it's been a mix, certainly a mix. And some of them get a sticker shock of some of the cost to build and impact fees here when they get into town. And it just is what it is, but they're coming here still because they want to be here. It's still, the affordability is a small challenge to overcome based on the desirability and what we've got going on in our community.
Yeah, I would be curious to see if, especially them, we went so long with so many great financial opportunities to where there's just less and less, and everybody's adjusting their expectations as far as their returns and things like that, and what like an acceptable cap rate would be versus saying, well, if I'm gonna plant my business here in a commercial property here for the long term, if I'm looking at it from a long play, you might be willing to, take less as far as like a return now than they would have been, say 3 months ago or 3 years ago.
Yeah, I think they have been, there is still some pickiness on that, but I think people have had to loosen up and be willing to take a lower return to be in this market versus a higher return to come here. we just closed on a deal in a smaller town here in southern Utah. It was a large national tenant, 10 years left on their lease, and it transacted for 6% cap. And that was in a small town, not one of our major towns here. So if that was here in St. George, I'd say it probably would have traded for about 1/4 to 0.5% less, which would have put it in the low to medium 5% range. And you can see there's a couple of deals on the market that are investment deals from national type groups here. One's a land lease that's being offered at a 4 3/4 cap. So if it's a really strong tenant, I think you will see some of that drive to a lower cap rate. But I think if it's still ma and pa local tenants, to account for some of the risk that's going to be factored in, it's still probably going to be in that mid to low 7% cap range. I don't think you're going to get ma and pa tenants that are going to be traded at the 5 and 6 cap range.
I mean, maybe not even regional, right? If we were to talk about companies that are out of California that might not be, big players, but want to move their medium-sized business here, I'd be surprised if they took less than 7% cap. I don't know.
Yeah, you certainly got to take into account their balance sheet. And that's some of the things we're asking for before we even make offers are made, is send a financial company. Let's see how their sales were. Let's see what their track record is on paying rent, on income, on their stability as a tenant, especially given the last 6 months, and then reevaluate the risk and try to make an adjustment for price based off that.
Yeah. Hey, Mitch, I'm glad you're on, man. I appreciate you jumping on. Are you seeing anything pushing forward in Desert Color? Have you seen, I know I've talked to Carefree Homes. I know they had quite a bit of activity finally be picking up. Have you seen much change in your pace of development out there?
For us, it's just been pretty much like the message that we've been hearing across the board. I'm sure the other developers are in the same boat. I always equate what happened was, it's like we were barreling down the freeway, right, at 85, or for some of you, lead feet, 90. And you see something in the middle of the road, a big tire or something, and so you kind of slam on your brakes, right? And you didn't come to a complete stop, but you certainly calmed down. And now we're trying to get back up to speed. The problem is that little period where I think there was a bit of a hesitation across the industry, it's kind of catching up to us. And that's where I see us being a little bit behind on lot deliveries. Generally, I think that's, all developers are probably pushing to ensure that they're hitting their lot deliveries and everything else. It's been, we're well above our annual absorption that we were expecting out there. The problem right now is just getting everything out of the ground. So really high traffic numbers. A lot of people that we've been hearing, West Coast, a lot of people are coming in looking for the master plan communities from the West Coast. We're seeing interest in commercial. I really appreciate what Wes was saying. I think he's got such a great pulse on what's going on. So Wes, you're a great resource for all of us. And it's going to be interesting. The next 12 months, it's going to be like, all right, what can we catch up to and keep going? But all of our builders out there are having a lot of success, and so things are going great.
I like hearing that. I feel like, they talk about in the stock market, the V type recovery. I think what you're saying is kind of right, is the housing just went through its kind of V type shape of a rebound. So I'm hoping to see inventory continue to climb. It's going down. I'd like to see it climb to help, balance out the pace so that things don't get too out of control from the pricing standpoint, because balance is really in the best interest of all of us from an economic standpoint. And then allowing lots to catch up, allowing builders to be able to go vertical and catch up. Obviously we're trading what we missed in spring for what we're having now in late summer and then into fall. So hopefully we can catch up by winter time. And luckily we're in St. George, so we're not going to have to deal with a whole ton of weather. Builders are going to still continue to be able to build and not have to, let's hope we have a mild winter, maybe if we don't have a crazy winter, but it would be right on par if we all had like a foot of snow drop in St. George. That would make sense for this year, right? But I think things are looking good. I like seeing things going great. I like watching and seeing what things are happening on a regular basis. I'll continue to have these. I'm going to try and get some more city officials on just to reiterate what they're doing from a state and local government level in helping both Washington County and then Utah as a whole continue to drive forward. I hope your kids are staying safe if they're going to school. I know a lot of my agents at Keller Williams, they're opting either, some of them are having the kids stay home, some of them are still having them go to school. So as an industry of entrepreneurs, I know you guys all have your hands full with that. So I want to wish you guys all good luck with that, and hopefully we can lean on each other to get through some of the craziness. Do you guys have any other questions? It's just about 10 o'clock, or we can finish up early.
Thanks, Robert. Great call, man. Appreciate all you do to set it up. And
Hey, Robert,
for joining. I'd love to hear all your insight.
Yeah, thanks, man.
did you go over rates?
Rates. I didn't have anybody go over rates. I know we're probably sub 3 or sub 3. I don't think
Our understanding is all refinances, period, have a 0.5% hit as of September 1.
Meaning what?
Fannie Mae and Freddie Mac. What?
A 0.5% hit, meaning going down?
No,
No, up.
Oh, okay. As of September 1, huh?
A hit for a refinance. Fannie and Freddie are getting concerned. Everybody's refining.
Ah, very interesting. That's something we'll want to watch. Will you guys pay attention to that and jump on next call?
Yep.
We should check into that because I heard from a lender that was only on FHA refinances. Is that different than?
our banker said all.
Our banker said as of, we just talked to her yesterday,
She said
all
all refinances.
refinances.
All refinances?
Fannie Mae and Freddie Mac.
Wow.
And they're doing a short one. They usually give you in the past when we've been in the business, 2, 3, at least 30, 60 days to get whatever's in your pipeline out. They're not doing that this time. September 1. So whatever's in the pipeline right now is actually getting affected.
Well,
and they're really concerned on self-employed.
Well, that's going to be interesting. We're going to meet again on the 28th, right before that. So I'll see what I can do about getting as many lenders in town on the call to have that discussion, just to, because I think that'll be interesting just to see what happens with demand. Because if that pushes, if it's refinances though, it might not really necessarily hurt the housing market in general. Obviously, somebody they're bummed that they have a 3.5% interest rate and they can't get lower, but I don't know if that's necessarily a horrible thing, but it's something to watch, I think, for sure.
Yeah, so it might be just for self-employed, or it might be for employed. I didn't ask the question. I just heard that it was all refis.
Awesome. Well, we'll pay attention to that. Thanks for bringing that up because I'm going to check into it. All right, guys. Have a good day. Take care. Have a great weekend.
Thanks, Robert.
See you guys.